Hello, my name is Charlie Moran. I'm a senior analyst here at Value Line, and I'm joined today by three other senior analysts, Alan House, Sharif Abdu, and Nate Ekman. Today we're going to provide an update on the economy and stock market. We will then recommend one stock to buy right now and finally answer any questions you may have. Please note that this presentation will be available on our website at valueline.com and on our YouTube channel within the next 48 hours. All previous webinars are also posted. Before I jump into the heart of the presentation, for those joining us for the first time, I want to provide a brief overview of who we are at Value Line. We are a New York headquartered corporation that has been providing investment research for more than 90 years. Our flagship product is the Value Line Investment Survey. This service is a unique source of financial information and is designed to help investors make informed investment decisions that fit their individual goals and levels of risk. The product includes data, information, and analysis on equities that trade on the New York Stock Exchange, the NASDAQ, and the Toronto Stock Exchange. It also includes economic commentary, easy-to-follow model portfolios, stock screens, industry-based analysis, and much more. This service, which is published weekly, is created by Value Line's research department, which is comprised of more than 70 analysts, economists, data experts, and quantitative specialists. One thing I want to stress is that our research is completely unbiased and independent. Unlike many Wall Street brokerage firms, Value Line has no investment banking business with any company, including all the equities under our coverage. Value Line does not execute trades for its subscribers and therefore has no vested interest in whether our subscribers buy, sell, or hold a specific equity. What's more, our staff of professional securities analysts are not permitted to own shares of any company that they cover. If you have any questions about the products or services we offer or our different tiers of subscriptions, that information can be found at valueline.com, or you can call 1-800-VALUE-LINE. Now let's discuss the economy and the stock market. This content was prepared by Value Line's economic staff. The April price data showed inflation is moderating. Following an on-trend consumer price index reading, producer wholesale price growth also eased last month. Specifically, the PPI, the producer price index, rose 0.2% in April and was up just 2.3% over the last 12 months. The latter figure was, investors should note that another round of inflation data, the May reports, will come before the next Federal Open Market Committee meeting in mid-June. More benign price data may give the central bank the opportunity to pause on the interest rate front. Further increases after raising the federal funds rate by 5 full percentage points in a little over a year would put pressure on the housing industry, the banking system, and the commercial real estate business. The consumer sector has proven resilient, but with pandemic-era savings eroding, more consumers are paying credit cards late, according to the New York Fed, while balances grow. Pressure on consumer spending will likely follow. The economy is slowing, with both manufacturing and residential construction activity weakening. It also is worth noting that initial weekly jobless claims have spiked this month, which suggests that the Fed's efforts to slow job growth are starting to gain traction. This would not be good for consumer spending and would add to the growing worries about the U.S. economy. On point, April retail sales rose 0.4%, which was half the consensus forecast, and home improvement giant Home Depot lowered its full-year prognostications. This first quarter earnings season proved better than most had expected, with more than 90% of S&P 500 companies reporting. Nearly 80% posted positive earnings surprises. Still, S&P earnings are estimated to have fallen 2.5%, which would mark the second consecutive quarterly decline. The next few quarters may be weak too, as the consumer feels the full effects of higher borrowing costs. On that note, Value Line is providing a great deal of information and analysis to help our subscribers. We know that most of our users depend on our weekly stock reports, time-tested ranking systems, and other valuable services. In addition, Value Line provides a great deal of daily content that can help you avoid the pitfalls and profit during this volatile time in the stock market. Every business day, senior members of Value Line's research department review the most actively traded stocks, company press releases, news stories, trade periodicals, and other sources for data and information that may change our view and investment recommendations for specific stocks. When something noteworthy crosses our desk, we immediately publish a supplementary report that outlines the new information and, more importantly, what it means for the stock and shareholders. This content is posted throughout the day on our website. Again, that's at valueline.com. I will now show you how to access it. Once signed in, head to the dashboard where I am already located. This is the main landing page for subscribers. Under the quick links, click on Supplementary Reports. As you see, the research department has been busy publishing our updated thoughts on the stocks that we track. We strongly suggest that subscribers visit this page often. Some individual companies incurred a lot of debt or sold stock to improve liquidity over the last few years, especially those dealing with sharply reduced demand for their offerings and supply chain problems, among many other issues. Due to the changing structure of company balance sheets, Value Line has been reviewing and altering our proprietary financial strength grades for the stocks in our coverage universe. These changes are posted each week in our Selection and Opinion newsletter. For those of you that don't know, financial strength, along with price stability, another proprietary Value Line measure, are the two metrics that are used to calculate a stock safety rank, a key measure of risk. When considering a new stock to invest in, we strongly suggest that you utilize financial strength and safety in your decision-making process. For more information in regard to our proprietary ranks and ratings, Value Line provides a user guide that can be accessed via the investment education section of our website. Lastly, this is a good time to mention that the case for individual stocks is quite strong over broad index funds. Now let's move on to the one stock to buy right now. For this, let's go to the screener. Value Line subscribers have access to 15 preset screens and 50 fields. I should also mention that another 100 or so fields are available, but it requires a higher level of subscription. If this interests you, please call 1-800-VALUE-LINE. So let's go to the screening criteria. The current economic environment remains uncertain, marked by inflation worries, geopolitical concerns, and the possibility of a recession. Many large, well-known stocks have grabbed headlines lately, but we would like to search for other equities with better long-term potential with average risk profiles. We'll start the screening process by looking at the safety rank in the ratings and ranks section. So the first screen that we're going to apply is a safety rank, and we would like to have a rank of 3 or better. There are many risk measures to consider, but today we're going to start by applying our time-tested safety ranks. Safety measures the total risk of a stock and is arranged on an easy-to-understand scale from 1 to 5, with 1 being the most conservative issues. I want to highlight the fact that stocks ranked favorably for safety have in the past held up far better than the broader market during corrections and downturns. They also meaningfully participate in up markets. For more information, I encourage you to peruse our ranking system guide, which is available free of charge from within the investment education section of our website. We're going to focus on stocks with a safety rank, again, of 3 or better. And by applying that first criteria, we've trimmed away our potential candidates down from 5,700 to a little over 2,000 candidates. The next filter we will apply is an industry rank between 1 and 20. We would like to select our stock from an industry with a favorable rank. Of the 98 industry ranks, we have chosen the top 20. And by applying this criteria, which we'll do shortly on the screen, by applying this criteria, we've cut the list down to 309 candidates. The third filter is the 3 to 5 year appreciation, and this figure is derived from analyst projections of cash flows, earnings, and the terminal valuation over the next 3 to 5 years. We would like to have an annual potential return above 20%, and our list, when we apply this criteria, let's see how many we're going to narrow it down to. About 250. The fourth criteria, or fourth filter, is market cap. We would like to find some names that are a bit below the radar, so to speak, so we are going to focus on mid-cap stocks, and these stocks have market capitalizations between $2 billion and $4 billion, excuse me, $2 billion and $10 billion, and applying this filter, we have reduced our opportunity set to 96 names. And we are going to apply a performance criteria by looking at 18-month target price range midpoint. We want to look over the intermediate term, that is the 18-month investment horizon. So scrolling up to the company data section, we're focusing on stocks with 18-month appreciation potential of 45%. 45% or better, which is double the midpoint of our current 18-month target price range of just 22%. And by applying that screen, we've narrowed the focus down to 9 candidates, which you see below. If you can make the screen go up a little bit so our viewers can see it, you can make a strong argument for any of our remaining candidates, and investors interested in adding new positions should consider them. However, only one can be today's one stock to buy right now. And after consulting with a number of senior analysts, we prefer and recommend CVR Energy. Before I click on CVR, please note that screens can be saved and revisited by utilizing the Create Saved Screen button at the top. So let's take a look at CVR Energy, noting the ticker symbol is CVI. Click on the CVR Energy, which will take us to the most recent report. If you go over to the right-hand side by PDF reports, you can click on there and you'll have the last 4 reports on the right-hand side. As you can see in the statistical array, or the center of the report that includes the financial data, earnings are hovering near past peaks reached a decade ago between 2011 and 2013. Revenues are set to decline in 2023, but margins should remain at wide levels. Still, the investment thesis highly depends on the stock's low valuation. Obviously, one must be more careful with cyclical companies, but we feel that the current P multiple overly discounts eventual declines in crack spreads, which are the basic margin barometer for refining companies such as CVR. Commodity markets are still relatively tight historically, boosting demand for CVR's offerings. More importantly, we think stock market participants will have greater appreciation for the company's relatively large cash flows as corporate America's earnings growth becomes more in question as the year progresses. The company should delever its balance sheet and has ample cash flow to cover its large dividend. The payout is somewhat variable, as one could see from the array, but we do not think that is in immediate jeopardy. Taking a look at some quantitative metrics, the stock has only average marks across the board, including a safety rating of 3, financial strength score of B, and a beta of 1.00. The issue has a nice upside medium price target for the 18-month target price range that is now 70%, and 3 to 5 year appreciation potential is more than 100%, which is well above average. All told, we think that CVR Energy, ticker symbol CVI, is poised for strong results in 2023 and beyond, and the stock can form one of the building blocks of a successful portfolio. It is today's one stock to buy right now. We will now tackle your questions. Please note that I typically can't answer complex questions about specific stocks on the spot. For this, I recommend a review of our latest reports. The first few were submitted prior to this presentation, and so now I will hand it off back to Alan, Sharif, and Nate. Thank you.
All right. Hi, everyone. So our first question is about the screener. We've been asked, is there a way to download the results of a screen into an Excel file? And to answer that, I'm actually going to pitch things back to Sharif Abdu, who's been running this presentation for us behind the screens to show you how you can download the results of the screen. So as you can see right there, we've got our screen up. And so you'll notice that there is a button, download data there. And so by clicking that button, you get the prompt to choose the format you'd like to download that data in. And then you simply click download, and it will format it into an Excel file that you can then save and access offline with a list of all of the companies that satisfy the, your screen and their criterion. So that's our first question. Our second question is how can you screen by an actual price-earnings ratio and not a relative price-earnings ratio in the screener? And that's also quite simple. You'll simply want to choose, you'll see in the valuation ratios section of criterion on the side, you have a number of options there. To search by a company's actual price-earnings ratio, you'll just select current PE ratio as opposed to relative PE ratio. For those who aren't as familiar with the difference between those two things, the actual PE ratio will, of course, be the actual ratio between a company's price and its earnings per share, whereas the relative PE ratio will be comparing that ratio to the average ratio for the entire universe of stocks covered by Value Line. And so those are our first couple of questions. Let's see, we got any more questions?
That sounds pretty interesting. Someone had a question about the difference between the safety rank and the financial strength rating, and I just wanted to address that. A safety rating is our safety rating is a proprietary Value Line measure of the stock's relative risk, where the financial strength rating is our rating for the company. So you think of the safety rank more as a, you know, a safety rank's more of a stock-related indicator, whereas the financial strength is based on the companies. And, you know, as far as the safety rank, an average safety rank is 3. And then a financial strength rating, an average rating would probably be somewhere around B double plus. So, thanks.
So we've got a question asking what the turnaround time for the Value Line Select service or special situations reports are, as in how long between buy and sell recommendations. And I can speak to this because I am one of the analysts who works on Value Line Select. And the truth is, we don't have necessarily a set timeline. It's always going to be based on our analysis of the company, of the stock. So we won't tell you to buy or sell an issue simply because we have, you know, a certain timeline in mind. It will be based on performance.
Okay, I also saw another question regarding the cash flow line and its relative importance. And excuse me, the cash flow line is it's a measurable value line. Identifies cash flow as net income plus depreciation, and then we use a proprietary multiple to come up with the cash flow line, and it generally roughly mimics the share price. Obviously, it's not exact, but we try to, you know, kind of make it in the same ballpark, so to speak. And I guess the logic being that if it's the price is above the cash flow line or below the cash flow line, it can be a good indicator of, you know, the relative, I guess the valuation of the stock. You know, if it's above the cash flow line, it might be slightly overvalued. If it's under, it might be slightly undervalued. I mean, it's not necessarily that simple, but that's kind of like a good indication of what the cash flow line represents. There was another question regarding the, you know, this particular about the timeliness rank versus 3 to 5 years, and this particular stock, CVR Energy, doesn't have a timeliness rank. It's currently suspended, but you know, Value Line is known for its timeliness ranking system. It's been intact for decades, and that's a measure of relative performance over the next 6 to 12 months. We also have the 3 to 5 year projections, as you can see all the way to the right. Right now, they're through 2026 to 2028. So that's a good gauge. Some people are looking for, you know, performance over the next year or so, where other people are looking for 3 to 5 years or more. So that's why we use both of those factors. There's also, we introduced probably maybe 5 to 6 years ago, the 18-month appreciation potential, which Sharif just highlighted. That's right underneath the box of timeliness, safety, and technical ranks. That's a good indicator about how the stock, we expect the stock to return over the, perform over the intermediate term, so the next 18 months or so. And as you can see, CVR Energy has a 18-month appreciation of 70%, which is very, very good compared to the Value Line median. So, thank you.
We've got a question asking what exactly is represented by the institutional decisions box, which you can see right there. So what those numbers represent are the number of times in a period that institutions with more than 100 million, in funds have made, that particular call in the specified period to buy, to sell, to hold. And I would also like to refer, for things like that, we have a guide on our website, how to read a value line page, that lays out those sorts of things in for that section and other sections on the page in much more detail. You can find that on our website. It's quite useful.
Okay, thank you. I also saw another good question that just came in to ask how we, got to the 9 stocks. And, we went through step by step, but I'll just refresh that for anyone who may have joined us late. We started out with over 5,000 stocks, and we did a safety. The first screen was a safety rank of 3 or better, and then we did an industry rank of in the top 20. Then we did 3 to 5 year appreciation potential. Annual appreciation potential of at least 20%. And then we did market cap in a range of 2 billion to 10 billion, which under our categories is mid cap. And then we did 18-month total return, target price range midpoint of 45% or better. So we whittled the list down from over 5,000 candidates to the 9, and then we consulted with other senior analysts and economists to come up with our choice for this month, which is CVR. Thank you. I also saw another question regarding, someone asked why we chose the market cap we did, and all these are are somewhat subjective, try to generate these screens. But I think, given the current market and there's definitely some, uncertainty in this market, we thought that we didn't, we wanted to go at least mid cap, and we thought, a mid cap can offer some safety and some perhaps return potential, which this stock does. So it's kind of arbitrary. I mean, people can screen these. The good thing about these screens is you can kind of play around with them as you may. You can say, well, I want to do mid caps or small caps, or I want to stocks that higher P's, lower P's. I mean, there's many different factors you can use for these. So that's something that you could use. And then if you find a screen that you like, like as Sharif noted before, you can download it, and then you can use it on Excel. Okay, I don't see any more questions. Well, thank you all for joining us today, and with that, I'll turn it back to Brandon.
That concludes today's session. Thank you all for joining. You may now disconnect your lines.